Hello traders, Nick Shaheen here looking at the banks. We've had a few report and a few more to report this coming week or two. JPMorgan, Wells, and I forgot who the other one, maybe BAC. No, it's not. Anyway, they reported and the reaction was red. That doesn't mean the earnings were bad. They have been unshackled now. They can buy back stock. They have dividends. I think Wells Fargo is the only one that has some sort of a special circumstance, and I don't know what it is exactly. But they were refrained from offering dividends except in relation to their net income. So let's tackle the first one first. Bank of America, it's doing well. As far as from trading perspective, this is not an obvious place I want to get long. If I look here and I look left, last time they were here, that was a crash. This was the 2020, the pandemic debacle. They don't usually just take it out. It would need something special to happen. So for an investment, if somebody wants to own the bank for a long time, they make sense because they do pay 4% just over in yield, dividend. So that's a lot more than what you can get anywhere else. Certainly you cannot get that from bonds. Mind you, bonds are, quote, safer, but I'm not sure how safe the U.S. bond is after just seeing what they're spending right now. There's going to be an event in the next 20 years that's going to shock the world probably, because this amount of money flying around is just, $1 trillion, folks, is a lot of money. I bet you if I ask right now, everybody listening, what comes after $1 trillion? I bet you most won't know. That's how high of a number that is. So in this case, from a trading perspective, I'd wait for a dip. Also from a trading perspective, 32 sticks out, which is kind of a strange looking candle. It shows indecision. It could be a base, but I would be much more comfortable buying it closer to 30. I know you think it's impossible for it to get to 30 or 29. Most of this rally, I guess I should have started with that, in the banks came from the rally in this. Yields, bond yields, the US 10-year, for example, that represents how much yield a bondholder gets on the 10-year. It's been in a toilet for a long time. It just peaked above 1. And that rally, it doesn't look like much. That is a lot in yield terms. So this rally is what brought the banks to their pre-earnings level. So look, the charts look almost identical in relativity. So Bank of America, I would wait. I'm going to zoom out to a weekly chart to show 5 years worth of data to see where it stands, and then more importantly, I'm going to go to monthly because that's pretty important for this bank, and I'll show you why. All right, so it's been much higher before. This is the 2008 financial crash. It took on a lot of debt. It took on a lot of pain because it was forced to gobble up loser banks so they don't collapse like Bear Stearns. IndyMac, I think, was one of them. Somebody else, I can't remember. But anyway, so they did the right thing at a high price. It took them this long to get back half of it, basically. Probably a little more than half. But here's the exciting part. So this is, like, they rallied. These are monthly, right? So this is 2016, the February 2016, and then the election of Trump area. Actually, this was the election of Trump right here, this one. And then they gave back a lot of it, but what they did in actuality, they actually tested for footing. So this low, 2017, was a gift, and it wasn't a time to leave the stock. So now that's an absolute dead floor. This is a solid floor, anything around 23 to 25. 27.5 to 28 is a good floor. 30 is decent. So just to give you relativity. And what's the upside potential? If they can pierce through this giant, colossal mess of resistance right here, they can get to 40 and higher. But these are monthly candles, folks. So 3 months green, huge greens. Can it breathe another month? That's fine. It could. It's not oh my gosh, it's going to collapse. I just named a lot of floors below it at certain levels, strengths. So pick your entry point. So if I wanted to own it for the long term and as an investment and own and earn 4%, I would probably also sell covered calls for that. If you don't know what those are, you can message me or just read up on it. I don't sell naked calls. That's not the same. That would be shorting stocks. But if I owned 100 shares, I can sell one contract against them and collect some money. What do I have to do in return? I have to promise that I would sell my shares at a higher level. That is the commitment. That's why I'm collecting money. So who buys these things and I sell them? Somebody that wants to get long Bank of America without being long today. So they reserve their price. So they say, hey, you have 100 shares. I want 100 shares. I'll buy them from you at 35. And to reserve my spot, here's some money. Hold this money. If time passes on it, because they all have a time limit, and it expires and price is below 35, they're not going to say, give me those shares at 35. They'd be stupid. It could happen, but they'd be stupid. So the worst that could happen is I have to sell my shares at that price and keep the money they paid me as a premium. Okay, so that is Bank of America. JPMorgan is at all-time highs. So if I wanted to short banks, that's the one I'd short. If I wanted to go long banks, that's the one I'd go long. I don't want to go long banks. I definitely don't want to go long a chart that looks like that. I don't care who it is. That is not a technically inviting chart for me. Where would it be? 120. That would be where I'd say maybe I'll nibble there. You're saying I'm crazy, but I have to say if I didn't get long JPMorgan already, I missed it. In fact, I didn't miss it. I shared 2 trades last year. They were pretty darn good with it. In fact, one of them was a huge home run somewhere. I can't remember where. I want to say here. I'm not sure. Maybe here. But if you look at it, this is a daily chart. It's just like Bank of America at prior failure, but it did better than Bank of America. This is the darling of Wall Street. It's been anointed. I like it better than Bank of America here because it doesn't have a lot of mortgages, if any, I don't know. Bank of America is loaded, and so is Wells. And the mortgage situation in the U.S. could be a problem. I read that 8%. When they say 8%, I'm going to say 10 to 12% of all mortgages are in forbearance. So these Bank of America and Wells, I think, are number 1 and 2 in mortgage holders. So what's going to happen when these forbearances come due? They've been kicking the can, and I think the can has to land in April. They may kick it again, I'm not sure, but I thought it ends in March, actually. So what's going to happen in April? That's a big question mark. So how forbearance plans end is, you pay whatever. What's a forbearance plan? You call your bank and you say, I just lost my job because COVID. By the way, that was made law, so the bank can't say no to it, and you don't even need to call the bank. You can push a button on your phone and get into forbearance with no credit detriment to you. No late fees, no penalties. They just put everything on hold for 3 months at a time. And that extended from last year into March of this year. So you call your bank and you say, I can't make my payment. I've been laid off because of to no fault of my own, and the government said I can do this. Stop my payments for 3 months. Okay, let's assume my payments are $3,000. Now in 3 months, the way I get out of forbearance is I hand the bank $9,000 to catch me up and start paying my mortgage. So I'm going to guess that nobody saved up $9,000 in those 3 months in order to give that money to the bank and get out of forbearance. That's option number 1. Option number 2 is say, I can't do it all at once. Let's make a payment plan over 3 months or 6 months. So instead of $9,000, you pay your mortgage and another $3,000 to catch up on one of the ones you split, or $1,500 if you were able to negotiate 6 months. So now your mortgage payment went from $3,000 to $4,500. How much extra are you going to spend in life? None. You're going to be crimping. So that's going to affect the whole economy. Another option, which would be ideal, is if you have excellent credit. It's, I think, called a deferment. So you say, hey, I stopped paying. I'm back at my job. I can start paying again. I want to defer the stuff I owe to the back end of the mortgage, untouched. Boom. That happens. Then you're done. That was the perfect situation. If somebody has an excellent credit, I call the bank and I say, hey, I stopped paying for 3 months. I'm good now. Let's start paying again. And those things I skipped on, the $9,000, throw them 3 extra payments at the back end. So you end up paying extra interest, but that's fine. So that would be ideal. The last suboptimal situation is to say, I can't make the payments. I can make the payments going forward, but I can't catch you up with the $9,000, and I don't have good enough credit to use that deferment option. So then they have to modify the loan. And the way I understand modifying the loan is, it's basically a default and restarting a new loan under new parameters with a new note and everything. So that has to happen sometime first, second quarter. I don't know. I thought it was March. So we'll see what happens with Biden. Can he rewrite the thing and say, no, it can go? Also, there's forbearance on rent. So how this affects banks, I don't know, but it's going to affect Bank of America and Wells the most. Whew, long side note there. Anyway, JPMorgan is the cream of the crop per Wall Street, and perception is everything. I would love a dip to 128 before I can even think about buying it. So if I wanted to trade it right now, again, I can own this for the long term. It too pays about 4.5% in yield. So I can buy it, earn the yield, and sell covered calls against it above current price to try to generate more yield out of it at the risk of losing my shares at a higher price. Okay, so that is another bank we talked about. Wells is the black sheep of the family. So I looked at the P&L and I can't make heads or tails of it. Their income just collapsed last year, whereas the other ones actually grew. So I don't know if they took a bigger charge. I thought they didn't take any charges for loan loss reserves. So I don't know what went on. It's a very dirty P&L, but I like it the most because of that. It has the most things that can get fixed. So that's upside potential. If they fix them, boom, it's got an explosion coming. Look at where it is relative to its COVID crash. It still has, it's relatively lower, and it's relatively lower to, this is 12 months. Let me go back to JPMorgan. Look at how it is relative to 12 months. At even par, a little bit higher. Bank of America. Same story, almost there, right? And then I go to Wells. Not even halfway. In fact, yeah, if you take from here, 12 months ago, February, to here, it's, we can measure it actually. Let's call Mr. Fibonacci. Hello? What's his name? I don't know his first name. Where's the 50? Somebody changed my settings. Anyway, I'm drawing a blank here. It used to be green. It's nowhere near. It's about 50%. And I'm going to extend this. Check this out. Oh my gosh. Okay, so you saw this, right? I just extended 2 candles from here to here. I didn't change up or down. Look. I took a rectangle I drew in April of last year, and I just extended it. And look what happened. This came inside of it, and look at these 2 candles. Boink, doink. Somebody that doesn't believe in technical analysis should believe. Okay, so 30 is a good entry point. I think buyers will step up from a trading perspective. Breaking 35.25, I'd get long in a big way because it's going to burst to 40, stall at 41-ish, plus or minus 50 cents, and try to get to 44 or more. But I think it'll drop one more time. So ideally, I want to see it do this. So it did drop, right? It had the biggest drop last week. It's probably going to do this and then eventually break out from this one to, what did I say, 44? Yeah, we'll put it there. There's a line there. I don't know why. So let's go to a weekly and see where that line came from. Oh my God, that is a disaster. Oh, okay. So that's where that line came from. See that? This is perfect. I didn't even see that coming. I just switched from daily to a weekly chart, and we come back to a place they absolutely thought they would buy it. They absolutely thought they would buy it, and a third time, and then the last time they just sliced right through it. And when they come back to it, it's going to be a problem. So that would be my target. So What I'm saying is I want to see a drop and buy it on the drop. So how can I jump the gun? I can sell puts. So if I wanted to own shares, that might be a good strategy. I don't know the premiums there, but I'll share it next week if I see it. I'm going to make a note right now before I forget. So the strategy there would be to start buying the dip even before it happens. I can do it now or Tuesday if we have another red day. To sell the puts, hopefully we can get some premium down in the 26s or 25s, I don't know, out in time. And a few days later, buy the calls in anticipation of this upside potential. So whether it breaks out or not, I don't like to anticipate. I should wait for 35.x, whatever that was, right here. I should wait, yeah, 35.2. But I want to anticipate if I get this. If I'm down here, I would, anywhere near 30, I would buy calls as well. And these will be slow moving, like GE and Ford, out in time. So I don't know how long it's going to take it to do this, but it should. The alternative is it doesn't, and it falls into the puts I sold, and then I have to buy shares down here, which I would with a very tight stop. Because, like I said, there's something weird going on with the financials that I cannot explain. So this is a yearly statement. Their revenue goes from 100 to 90 to 110 to 80 to 79, and the net income just collapses from 22 billion to 3. They take a 17 billion expense here. I don't remember what that was. Did they settle for a big amount? But anyway, so if it's a one-time amount, then I'm okay. That's even a better scenario to happen. But it might be longer, so I may have to give it another month. That's why if I do sell puts and buy calls, it'll be out. Maybe to include sell the puts before the next earnings and buy the calls after the next earnings. This way I'm not taking on the heat from the earnings and risk some whoosh down, and my calls will have the opportunity to live through the earnings for a lottery ticket. All right, so this is those are the 3 banks I really care about. I also shared a short Goldman Sachs last week ahead of the earnings, and that played out the next day really well. I still don't like it up here, so if somebody stayed short, I can't blame them. I would buy it closer to 260 or 270. And they report earnings coming next week. So here's the tricky part. Last year, the story was they were switching to retail. So the strength of Goldman was the fact that they were shark traders. I don't know how well they're going to do in the retail segment. They had a credit card with Apple. Is it going well? Is it not? I don't know the details. They had some sort of a first name person as a banking thing that they were trying to push on ads. I don't hear that anymore. But it's probably there. I don't know. So I don't know what's going on with it. So the earnings are a complete mystery. So if I'm short the bank with real money, I want to book some of it because earnings reactions are complete coin flips. The banks crushed earnings and they fell. That's just another proof that there's no way we can forecast what happens. All right. Anyway, this video is getting pretty long, and hopefully, but anyway, it has many tickers, so people can fast forward. Closer to 68, I'd be a buyer in Morgan Stanley, and they still haven't reported. Citigroup is kind of a strange. I shared a long trade last year that was a big winner. I believe I would probably entertain buying it closer to 60. It still hasn't reached its prior heydays. This is the COVID gap, would be closed, this little guy right there, but it's almost kind of closed because of this little tick here, so there's no like pressing need to close it in my opinion. This is going to be a tough watermark to beat. I'd be surprised if they beat it. So if I'm getting along off of one tick, albeit it was down 7%, now it's become an island. So it's really easy to wait it out and see what happens. 60, 57, 50, those are 2 places I'd consider buying. So if it doesn't hold at 57.50, they want to get lower for some reason. They don't need to. I think 50 is darn good floor. So I could sell puts there for to see if I can get assigned the shares. So that's the story there. And the quality of it, I don't know if it's the old Citi or not, so you can do your homework on that. Okay, so we can look actually. How expensive is it? So 1.5 times sales. They used to be less than 1 time their sales. And price to book, that's pretty important for price to book. 0.82. They don't even give it credit for its book value. So that's still good. And the PE is 13. They were single digits not too long ago. So they've gotten more expensive, but in absolute terms, the banks are still cheap. Now you have to, again, I'm going to end this video by where I started. You have to know what's going on here. So this is the TNX. Last year, I shared a breakout in yields. I said there's going to be a mega breakout in yield. And I said, let's go along the TBT. It didn't come as quickly as I wanted to, but that's what just happened here. TBT and TNX go the same way. One is a ETF, and one represents the 10-year, and the other one is the ETF that plays off of it. So this was my upside arrow, right? And they're almost there. I think they're there and they're done. And if they're not done, then the stock market's in trouble, because eventually CNBC is going to freak out over this. Remember in 2018, February, the market crashed for the first time. We had a bull market, and that was the first crash. And it was over a hot TNX. That's it. CNBC came up, oh my gosh, we are close to 3. What will happen if we hit 3? Job, labor, raising rates, the Fed's going to raise rates, and the whole world stopped, and we corrected the first time. They did the same thing 2 months later, if not a month later, over another jobs report, because it had exceeded 3 and it went to 3.22. They said, what if it hits 3.25? They freaked out over it. Art Cashin came on. The world will stop rotating. It was going to go flip the other way. Anyway, so that didn't happen clearly, but it will freak the stock market out. So we saw this coming, and it played out. Look, I said it's going to be a dip and then a rip. So timing was a little bit off. If somebody stuck with it, they made good dig. But that will affect banks. The rip here affected banks. So if I put the XLF here, it'll probably look the same. Yep, but at a higher level. See the recent poke up. All right, so this is it, folks. Long video, but I think it's pretty comprehensive. Later, bye.